Hey everyone, it's Rob B here with Rob D, and you are listening to the Property Podcast. We're making a big claim. We are saying it's the best time to invest in 40 years. That's, to most people, going to sound crazy. But I tell you what, I'm all in on this. And by the end of the podcast, I'm sure you will be too.
Welcome to the Property Podcast. Thank you for joining us. In case you don't know, we run a business that buys more than £100 million worth of property every year for our clients. You can find out about that at propertyhub.net/invest. And because we're out there doing deals every day, we know how people are feeling about the market. And they are, for the most part, not feeling good. But we believe that a lot of the negativity around at the moment is misplaced. And today, you're going to find out why.
So it's time for our news story of the week. And this week's news story was taken from MSN. That takes me back. The headline reads, these 10 northern house price hotspots have seen values soar more than 10% in a year. Rob, 10% in a year? Have we got an old article? This doesn't seem like it should be correct. But spoiler, I know it is.
Yes, it is. It's all happening in the north. We've spoken many times before about this north-south divide that has opened up, where not just the best yields, but also the best capital growth happening in the Midlands and upwards. You really see it when you break it down to a postcode level and don't just look at the averages. That's what Hamptons have done. They're reporting on data from the ONS. And the biggest annual increase in house prices was in Blackburn, putting on 14.4% year on year. Now, obviously, when you've got smaller areas, there are fewer transactions. Therefore, the data is going to be more extreme. But still, 14.4%. Blackburn is not alone, Rob. North East Derbyshire up 13.4%. Hartlepool, Liverpool, Newcastle all name-checked as having double-digit house price growth. I don't know why you moved south, Rob. Big mistake.
Oh, so I could be closer to you, Rob. But the interesting story for me with this one, Rob, is it's not being reported anywhere widely. Double-digit house price growth in major towns and cities across the north of England. That's huge. That's actually the start of boom territory. Now, a bit of data doesn't make it a boom, but that is far from the narrative that we're hearing elsewhere. You know, the narrative of, oh, well, property prices aren't moving. We got the average last year of close to 4% growth. But remember, that's an average. And there's areas of the southwest, the southeast, London dragging that average down. So there are areas outperforming that average. Well, ladies and gentlemen, these are those areas. But they're not just outperforming it by a bit. They are really rocketing at the moment. This is something we definitely need to keep an eye on and keep reporting on, because this type of growth is really impressive. And if it continues, other people are going to take note and start paying attention to these areas. At the moment, the market is very peaceful. But if sellers start gaining confidence and buyers get a bit more aggressive, that market might not be as easy to operate in. So this news story perfectly ties in to what we're going to cover this week.
The world seems like a gloomy place right now. In fact, I think there's more negativity around in general than I can ever remember before. And from a property perspective, it's certainly easy to think, I've missed the boat. The best days for property are behind us. But Rob, we've got a controversial statement to take us into this episode, which is that this could be the best property market to get started investing in 40 years. This can't be true, can it? No one's going to believe this.
You know what? Let's get into the detail. But this is an important episode for me because I'm worried. I'm worried about sentiment, not just in the UK property market, but in the UK as a whole, whether it's the economy, the stock market, or the property market, which is what we're going to address today. But we feel it's misplaced, especially in the property market, because what you have is a lot of positive things happening right now, but everyone's a bit neg. Summer's here, people. Let's start celebrating what we have, and what we have is amazing. Is it the best time to buy in 40 years? We'll see. But I tell you what, you will feel a lot better and a lot more excited about the possibilities of what's achievable in the near and medium-term future once we've gone through these things. And I want to start with something that's really important and massively overlooked. We have had a crash. A crash has happened and it's out of the way. And once you've had a crash, the markets recover and go on to do good things. Look at all charts. They go up, 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 up. Then they crash. Then they recover and start going up again. We've had that crash. It's just that it was silent. Rob, it's the silent property crash. It has happened, but people don't realise it's happened.
That's right. And the bulk of it happened over a period of 18 months because we had that really aggressive inflation. Inflation of practically double digits, during which time the price of everything went up. And wages, although they lagged, have pretty much kept up with that as well, on average. I know lots of people will be grumpy that theirs haven't, but on average, it's true. So basically, everything's got more expensive. Eventually, everyone's earnings pretty much caught up to match. Property might look the same when it's measured in pounds, but measure it against everything else and it is cheaper. And you said it, Rob, but I think it's worth emphasising what a big deal this is, because we're a long way on from the 2007 boom that turned into the 2008 crash. So naturally, people are getting worried. And I think one of the biggest worries out there is, prices are getting higher and higher and higher. I don't want to be the idiot who buys just before property prices crash. And now, of course, it's always possible that something will happen, the market will fall further. But because property prices have fallen by more than 15% by the time you've adjusted for inflation, that is a crash. And that goes a very long way towards neutralising that risk.
And even better, if you want a crash to happen, it's that type of crash. It's the least painful. So if you held through that crash, it didn't actually feel that bad. But it's reset UK pricing, which means in real terms, when you look at the charts, property in the UK is really well priced right now. And we are also because of that silent property crash and the way the crash happened, we are now, since records began, in the longest run for property prices to double. Property prices haven't doubled in a long time. So if you go back to when they peaked in 2007, they still haven't doubled since then. But we're in 2025, which makes it the longest run we've ever seen by a very long way. And we don't know when the end date is. We don't know when it'll eventually be double of 2007. But the average is around 8 to 10 years. So we should have been past that point years ago. So there's a tremendous amount of value in the market right now, especially after that crash, which is why we're in this stealth phase at the moment. And this is the second reason why we're excited, because there's a stealth phase of growth happening. And why is it stealth? Because nobody is talking about it. Because of that before mentioned sentiment. Everyone's like, well, nothing's happening in the UK property market. It went up by 4% last year. And most people predict it to do a similar number this year, especially with rates on the way down. That will stimulate the market. But no one's talking about it. It's like this stealth growth is happening, but nobody is acknowledging it, which makes it a great opportunity to be buying right now, Rob.
It is. The best possible time to be buying is when everyone else is at their most negative. So normally, if you have what you'd call like a true crash where prices actually fall in nominal terms, like we had in 2008, then immediately after that is the best possible time to be buying, because who the heck wants to buy? There's just been a massive crash. But the problem is, A, you're terrified too, and B, it's really hard to get lending because banks have also just taken a huge hit. So even if you want to buy, it's very hard to buy. What we've got now is a stage where we've had this silent crash, but banks haven't been affected. They're still happy to lend. So you can get out there and invest. And because it doesn't feel like the sky has totally fallen in, you hopefully have the confidence and the belief in investing if it's the right thing for you to do. So you can get out there and take advantage of this stealth growth. And when you do that, there will be great deals out there for you to do, because most people, as you've already said, are feeling pretty miserable and are just sitting back. You've also got a whole load of landlords who've been in the game for 20 years, have done very well, and are deciding that now it's a bit too much like hard work and it's time for them to get out, which means there's even more good deals around. And even if you're not out there doing the absolute deal of the century, at least you're not under pressure to do deals. Because I remember this kind of market from 2006, 2007, Rob. We had it again for a little while post-COVID. That type of market when everyone's out there, everyone wants to invest, everyone's trying to do deals. It's just such a difficult market to invest in because you under so much pressure. It's bidding wars. It's hard to even get a viewing some of the time. Whereas if you've got the confidence to act in the type of market that we've got today, the stealth growth phase, it's so much easier.
Oh, it's a lovely place to operate. Not only is it just easier to get transactions done, but it's easier to get deals done. At Property Hub Invest, the deals at the moment are landing on our laps because sentiment is so low, even though the market is up. And this is the crazy thing, right? This is what is crazy. Even though prices are on the up, this is what stealth growth's all about. People just don't see it. It's moving in the right direction. People selling are still willing to do deals. Developers are willing to do deals. And we are taking full advantage of that. It's a brilliant time to operate. It is much more difficult to operate in a hot market. Hot markets will come again. That's just what happens. It cycles. But this is the time where you can do great things because you've got a market that's moving in the right direction. So that's reassuring. But you've got a market that doesn't acknowledge that direction. So you can take advantage of it. So what we've covered, for me, would be enough to be very optimistic about the market. But the list continues. And the next one is, people are used to the tax regime we work in now. So Section 24, very catchy name. It is tax, so probably about right. It came in between 2016 and 2020. It was phased in. And now people know how to operate within it. They know what structures to use. And if they don't, they can get tax advice to give them those structures. But there are efficient ways of operating in this new tax world. The people who were caught out were the people who were investing before then, holding in their own name. Yes, hello, that's Rob and I as well. So we had to adapt during those changes. But anybody investing now can operate in the most efficient way possible because they know what they're dealing with. And there seems to be no noise on the horizon of that changing. The taxes we have, no one's going to celebrate, but what we can do is put ourselves in the best place possible. And now we've had a number of years to understand how to do that and how to invest in this regime. And that is a great thing. Certainty is a good thing. Time operating in this tax system is a good thing because you keep tweaking things to invest in the most optimal way.
Exactly. This has been in place for long enough now that a couple of things have happened. One is that the mortgage market has caught up, and that's very important. Rates for limited companies are now only marginally higher than for individuals, if at all. And the process, it's a little bit more painful, but it's a lot better than it used to be. And the other is I think there's now less fear that there are going to be even more tax changes. Of course, rates can always change. We saw the even higher stamp duty surcharge coming in last year. But for quite a few years, there was this real fear that the punitive tax regime for individuals was going to be applied in some way to limited companies. There was this fear that everyone was being herded into limited companies and you go, we're going to tax you there as well. And I think that was a valid fear. Obviously, you can't say for certain what's going to happen in the future, but I think that the tax changes that have happened, along with other things, have cooled the market so much that it would be an exceptionally brave and probably foolish government that would discourage property investment even further by going and penalising property investment companies, which in itself has all kinds of issues because of build to rent and all the rest of it. So I think the tax changes from the government's perspective have done their job. So now it's done, it's happened, we know how to deal with it, the market has matured. This is just the new way of operating now.
And I'm pleased to say we have a new way of operating with interest rates because they have spiked, they've peaked, and now they are trending downwards. The market is starting to become more competitive. But I feel the best is ahead of us. That's why we believe now is a great time to invest because mortgage rates aren't spectacular right now, but they are improving. And with the rates trending downwards and more cuts expected this year, you can expect rates will continue to improve as the year goes on. There's a bit of a lag at the moment. The rates aren't quite as attractive as you'd hope with the way interest rates are dipping, but that's probably a big part of this sentiment piece that we keep talking about, that there is this negativity in the market, and that's in all markets, which means that we're not seeing incredible products yet, but I feel those products will be on the way, because when rates keep falling, the products will eventually catch up, and the market will acknowledge it. So rates are quite good right now. But in 6 months' time, I think they're going to be brilliant. And that, for me, can only improve the market, can only stimulate the market and push house prices upwards because it's cheaper to buy. But again, it's not being acknowledged. It's like everyone accepts that interest rates are going to fall, but nobody's really talking about what that will mean, what impact it will have. When interest rates are low and borrowing rates are low, look what happens to the property market. It goes up. That's what happens because if you have cheaper money, and cheaper money inflates asset prices, including property. The Bank of England have said it's going to happen. Everybody expects it to happen. So if we all accept it's going to happen, why isn't the market yet acting like that? Well, I don't know, but that's what creates opportunity. And that's why we believe it's such an incredible time to invest right now.
I agree, but it's all relative. Like you said, if rates come down, that now it's good, it's going to be brilliant. But the key point for me is that yes, that's right. But say you end up being able to borrow 4% rather than the 5-ish that you've got now. That's brilliant. But compared to a few years ago, it's not brilliant at all because we were operating for years and years and years in this market where borrowing rates were phenomenally cheap. But it did create this big risk, the risk that at some point rates would spike up. So you might be buying a property, it worked really well at the 2% you were borrowing at, but then rates went up to 5%. Oh dear. And that's a position that a lot of investors have been in over the last couple of years. The great thing about rates where they are now is if you're buying something and you're looking at the numbers as they are today, it's highly likely that those numbers are going to either stay the same or get better over your period of ownership. Because without boring you with the economic reasons why, but I wrote about it in my book, rates are very, very unlikely to go up substantially from here. They may stay put, but the most likely outcome is that they will come down a little bit, as we've been talking about, but not get back down to the crazy lows that we had before. So although that big spike in interest rates caused a lot of problems and it's hard to look at it as a good thing, it is a good thing if you're investing today because it means you've got a lot more certainty over your numbers. And that links us into our next point, Rob, because I said that the numbers are going to get better over your period of ownership. And that's for two reasons. It's because mortgage rates are likely to come down, as we've said, also because rents are very likely to go up. And that's been the other big trend of the last couple of years.
Yeah, rental inflation has very much been in play. We've seen a couple of years ago double-digit growth in rents. Rents have been pushing aggressively upwards for a long time now, and it looks like they're going to push on again this year. Maybe not at the same rate, but compared to the long-term average, way, way ahead. And that's because we have a supply and demand imbalance. We don't have enough properties being built. We don't have enough stock on the market, but we have more people. We have a lot more people. And with more people coming into the UK each year, that pushes up rental inflation. But also, think about it. When people arrive in the UK, when the population increases, because we have so much immigration right now, I know that's a hot topic, but it's reality. So if we just accept the reality for the moment, what do they do when they arrive? Well, they rent, typically. Some people will buy, but the majority will rent. So it just keeps pushing rental prices upwards and upwards, which means that in combination with rate cuts, we are seeing very, very good returns, or you might call them yields. The yields on investments right now are some of the best we've seen in the last 10 years. You wouldn't think so, right? Everyone's neg. Property, it's no good. But the returns say different. And the returns are good now at 5%. As Rob said, we could quite easily see a market where we're borrowing at 4%. Put that into your calculator. Look at what that difference would make to your return on investment. But the thing is, rents are going up as well. So with rents pushing up and rates coming down, it could improve even further. You hold your asset now, it looks quite good. You've got this stealth growth, you've got a good return today. But if interest rates cut further and rents keep pushing upwards, what's your asset going to look like in 2 years' time? Not 10. It's going to look a lot better.
Yeah, it's funny. I got an email from an investor the other day, which I've just pulled up now because it's about exactly this point. And what he said is over the last 4 years, he's done nothing. He hasn't bought, he hasn't sold, he hasn't improved his properties meaningfully. He hasn't done anything at all. His mortgage costs have gone from £2,000 to £3,000, but his rents have gone from £6,000 to £9,000 a month purely because of that rental boom. And he's also had a big capital uplift as well, which means his loan to value has gone down. So it's like, wow, through this period where everyone's been like ultra negative, he's ended up in a position by doing nothing where his equity position has radically improved, his debt is lower, and he's making more money than he was before because, mortgage has gone up, but rents have gone up by so much too. And from memory, he's operating in the Northwest, which would make sense because, as we've said many times on the podcast recently, that is the area where rents are going up the most and capital values are going up the most right now. And that links into another point, which is it's so much easier now to go and invest in the best possible areas. Compared to 15-ish years ago when we started, it's so much easier to share information. It's so much easier to operate remotely. And there's just so much more information out there that you actually know where the best places to invest are. You're not restricted to operating in your own backyard, and you're not stuck taking an estate agent's word for it when they tell you what's going on in the market. So Rob, saying this is the best market in the last 40 years sounded like an outrageous statement at the beginning, and I'm sure there are plenty of people out there who are not feeling the positivity to quite the extent we are. But so much of this for me is a mindset thing. It's about attitude, the facts, what's actually going on out there. But you can choose the attitude you have towards it, and that can guide you towards making decisions that keep you where you are now or that leave you in a very different position in the future.
Yeah. If you're waiting for your taxi driver to tell you to start investing, or the latest property program on TV telling you that the market is crazy good right now, or the newspaper headlines saying property boom is here, I worry for you. You're too late. The best market to operate is in when everyone's telling you it's no good, but the facts tell you otherwise. Nothing we've talked about today is really opinion-led. Interest rates are coming down. Rents are going up. We did have a silent property crash. The returns are really strong right now. It's a great market for doing deals. All those things exist. That's just the reality. But if you stop somebody in the street and said, should I invest in property? They'd probably take a deep breath in and go, oh, no, I wouldn't do that. But then if you ask a couple of probing questions to why, they probably fall apart quite quickly, because that's what sentiment is. It's just loosely held beliefs of what the market is right now, but not based on any real fact. It's more of a feeling than a reality. And if you invest on feelings, then you may as well go to your local casino and play roulette and have a good feeling about where it's going to land. Because that's how you are investing if you're waiting to feel a market. No, what you want is to understand a market. And even better, understand it when others don't. And when you put yourself in that position, you can really get ahead. This opportunity we have right now in the market is rare. You don't often have negativity matched with a positive reality, but that's what we have. This won't last forever. Eventually, people will wake up. When rates come down further and rents push on more, people will suddenly start to see what an incredible investment opportunity property presents. But while they're asleep, you need to be awake. And that's what this week's podcast is about, to wake you up. Hopefully you already were, but if you are not, we've given you a shake today. And hopefully that spurs you into action.
Okay, Rob, that was a rousing speech. I want to see if I can bring this back down with a really tenuous link. How about this as a link into Hub Extra? So, Rob, a lot of what we've talked about is about drowning out the noise and the negativity. And I believe you've got a Hub Extra that might help people do just that.
That's quite rubbish, that link. But I like it because it's so cheesy. What do we have this week? We have noise-cancelling headphones. Wait, don't leave, because this is really good. I'm almost as passionate about these headphones. Poor Rob and Dan have heard me talk about these headphones a few times and my desire to put them on the Property Podcast. But as it's summer season and people will be travelling more, I wanted to give you a resource you can use because these headphones are so good for the price. And this is the thing, it's a bargain. It's a bargain price, and that's why I love these. These headphones are so good that when I'm on a plane and I hear a child starting to cry or scream, I press my little button and feel very smug as I then listen to my podcasts or watch something on my iPad, whatever it might be. I just feel in a much better place because I'm not listening to any of that noise or chaos. And that's how good these headphones are. The battery life is phenomenal. It's got a super quick charge. They're Sony. So how much are we looking here? £200, £400? No. Today, my friend, I feel like I'm working with Del Boy at the moment. Today, my friend, you can have them for £70. Yes, 70 quid on Amazon. Absolute bargain. So I would highly recommend the Sony 720s. You can go way more expensive. And while I've had pairs that are 200 quid more than this, and you can probably just about tell the difference, there's not a lot of difference. For me, there's not £200 difference. Sound quality is brilliant. Battery life's brilliant. Noise cancellation's brilliant. If you want some bargain headphones, then this is my strong recommendation this week. The Sony 720s. We'll pop a link in the show notes, but a great present to yourself or to someone else.
Okay, well, in this episode, we've given you the gift of silence and hopefully the gift of motivation as well. Thank you for joining us this week. Hope we left you feeling good and ready to go out there and make some life-changing investments. We'll be back to do it all again on the podcast next week, so we'll see you then. Bye-bye.
Bye-bye.